All right, good evening, everyone. It's straight up 7 o'clock Central, and we are going to get started on our webinar for Coaching to the Profit and Loss. So I'm going to ask, my name is Jeannie Osnes. I am a MAPS coach, and I am also the Red Shirt coach for our new coaches that are coming into to MAPS to be new coaches. And so what we're gonna do is we're just gonna go ahead and put everyone on mute at the beginning. And then, so please just save your questions, and as we get toward the end, we will open it up for any questions that you might have. So in this course, what we're going to be doing is talking about how to read a profit and loss, as well as a few little pointers on coaching to the profit and loss. So let's get started, and we can go ahead and go to the first slide. So the agent profit and loss is what we're going to go over to tonight. It's made up of 5 different sections. We've got the income, the cost of goods sold. Sometimes it's referred to as cost of sale or COS. We've got expenses, what we call the below the line income expenses, and we also have net profit. So we're going to start first by talking about income. So we can go to the income slide. So the important thing to remember on the income is that this is the total amount of income, total GCI for the entire team. This is every dime that a closing of a buy or a sale has created before there's any split, any cap, any royalty, any referral fee, office fee, etc. So this is 100% of the GCI. What I have found is that a lot of our coaching clients, they're only reporting the GCI on their profit and loss for the Rainmaker. And yet we have to report all of that, because remember that the client's goals are based on the gross commission. We do their business plan at the beginning of the year. We do it based on the gross commission of the team. So as we're reading the profit and loss, we're obviously going to be looking at their income against gross commission, not just the commissions that the Rainmaker is taking. So this is really, really important that we're making sure that we're starting with the right number. So every penny is to be included. And again, it should be absolutely everyone on the team. So at the next slide, we're going to show income examples. So now this is not necessarily how you'll see every profit and loss. This is just one that is really easy to read, and we've got a couple of coaching opportunities just by reading it this way. So if you look with me, the first is the coaching income. The listing sold income, $77,751 and change. So this particular Rainmaker of this team, he's also the listing agent, we'll say. And so in this particular month, the gross income before any split, cap, royalty, anything else that they made off of the sales of listings was $77,751. The next line you'll see they also received referral income of $4,281. And then look at sales income. This particular amount, $28,414, this is the income that came in, commission income, that's staying with the team or with the Rainmaker. So this is in essence the split, the Rainmaker split. Sales income of $28,414. But now let's keep going. Now we see agent income. So this particular team has 4 buyer agents. We've got buyer agent 1, 2, 3, and 4. And you can see there next to each one of them how much income they generated off of buyer sales. And this is the portion that the buyer agents are keeping. So buyer agent number 1 is keeping $13,824, buyer agent number 2 is $46.65, and so on. And then you'll see at the bottom here, total buyer agent income, $34,189. That's the buyer agent split. That's the portion that the buyer agents on this team is keeping. So if you take the $34,189 plus the $28,414, what we see is on the buyer side of business for this particular team, they've brought in approximately $62,603. So now many ask, why don't you just lump it all together under buyer income? Well, we can, and you'll see a lot of profits and losses are that way. I'd like to see it divided out because of this. We can look right now at the sales income, the $28,000 that's being kept by the Rainmaker, and we can look at total buyer income and look at which one is higher. You see, here's a coachable moment right here. The buyer agent's income is $34,189. The Rainmaker's income is $28,414. So we know immediately that they're at a higher split than even 50-50. And we know from the MREA book, Gary Keller teaches us a 50-50 split, and we're talking more and more now about a 60-40 split, 60% to the Rainmaker and 40% to the buyer agents. So right off the bat, we know, and we can coach to the fact that they're a little bit out of alignment. What's happening is it's eating into the net profits as a result. Now you can see that the $34,189.16, it's actually in red. And the only reason that it's in red is for the teaching of this course, because I just want you to pay attention to that number, because we're going to come back to it. And then bottom line, you can see the example here is the total income for this team is $146,657 and change. So that's how you might report the income on a profit and loss. Now let's go to the next slide and talk about costs of goods sold, or cost of sale. Under cost of sale, you might find cap, royalty, there might be concessions, referral fees, and the splits. So when I'm working with some of the clients and they don't understand cost of sale, a really easy way to explain this is think of it this way. If you didn't have a closing, you wouldn't have had this cost. If you didn't have a closing, you wouldn't pay cap. If you didn't have a closing, you wouldn't pay royalty. Now, sometimes we see concessions in cost of goods sold. Sometimes we see it as expenses, but really, I like to see this under cost of goods sold, because a concession typically is an amount that the real estate agent had to pay in order to get this deal to close. So we all know that we've seen examples like this. Day before closing, the buyer and the seller start arguing over the $200 microwave. And finally, the agent says, fine, look, I will just buy you guys a microwave and let's just get this thing closed. That's a concession. The only reason they had to pay the $200 for the microwave is because we had a closing. So therefore, we can consider it a cost of sale. Referral fees, any referral fees that we pay out, that's also going to be a cost of sale. So the very easy way to think of it is just, again, if I didn't have a closing, I wouldn't have had this cost. So let's look at some examples on the next slide. Cost of goods sold, we have agent expenses. So remember a couple of slides ago, I told you that we had it in red, the amount that was going to the buyer agents called the total buyer agent income. We'll look at the top one, agent expenses, that's that same number, $34,189. So we show it coming in as gross income, and now we're going to see it going right back out as our splits to our buyer agents. So again, here you can see we might have concessions, $386. This agent is paying their cap and their royalty. Now make sure that, this is a question I've been asked a lot, do we report the cap and royalty of everybody on the team or just the Rainmaker? And the answer is that you only report the cap and royalty that is being paid by the team. If the Rainmaker for some reason is paying the cap and or the royalty for one of the agents on the team, then yes, we would report it. If they're not, then we don't report it. So typically you'll only see the Rainmaker's cap and royalty under cost sale or under cost of goods sold. Now, before we move on, look at the total cost of goods sold, $45,010.16. And you see to the right here, we've got 30.69%. That 30.69 represents of all of the income that came in through this team in this month, the $146,657, the $45,000 that went back out of cost of goods sold is 30%, 30.69. So 30.69% of everything that this team made went right back out in cost of sale. And so as coaches, one of our jobs is to make sure that the client is staying within budget. So if you look at page 193, if you have your MREA books, just get it out because we're going to refer to these a couple of times. Page 193, so put a little mark there and also mark 157 because we're going to go back and forth between those. So what Gary Keller tells us in those two pages, let's start at 193, is that the cost of goods sold, these numbers are for a millionaire real estate agent. This is somebody that's doing 2.4 million in GCI. Their cost of sale should be 29.2. This particular client is at 30.69. So as a coach, we already know they're a little bit over, not terrible, but 0.5% here and 0.5% there, at the kind of numbers like this team is doing, that's going to add up really, really fast. So this is another opportunity for us to talk about perhaps you're overpaying your buyer agents because it's already your cost of sale is a little bit out of whack. All right, so let's go to the next slide and we're going to start to talk about expenses. And in your MREA book, stay at page 193. This is the budget model. So what Gary has done for us is he's taken every one of our expenses and said that your expenses should fall into one of these 9 categories. And for a millionaire real estate agent that's doing 2.4 million in GCI, this is what percentage should go back out to staff salaries or to lead generation. So in other words, if they're bringing in 2.4 million, 12% of everything that comes in should go back out to salaries. 9.2% should go back out to lead generation, and so on. Now, flip over to page 157. On page 157, what Gary gives us here is 5 other examples based on their GCI goals. So you can see in the first column, the numbers line up for if this client is going to hit 180,000 in GCI, the next column is 300,000, 500, 800, and 1.2. And the reason that we care is because you can see that the percentages should change slightly and the cost of sale changes pretty dramatically. So we've got to make sure that we're coaching our clients to the right percentages. And you would do this based on either their actuals of what they're hitting or what they're trending toward, or to their business plan goals for the year. So here are the 9 categories. We have salaries, lead generation, occupancy, technology, phone, supplies, education, equipment, and auto. Just a quick note, something to be aware of. Go back up to education. It says education/dues. On page 193, it's only referred to as education. On 157, it's referred to as education/dues. So we're going to go with the 1% for education/dues. Now, I'm also aware that from Gary Keller on down, I mean, he himself has been showing slides with Jay Papasan about here's what the new MREA book, the budget model is going to look like. And I've seen, different budget models being floated around and different percentages keep coming out over and over again. I've seen it as far as, seller cost of sale is going to be 5%. I've seen as much as 10%. And there's just a lot of different ideas floating around. So Tony DeCello and I actually had a conversation about this just yesterday. And what we're doing is we're just saying, you know what, until the new book comes out in print, we're going to default to what Gary has been teaching us. We're always going to default to the MREA unless Gary has said, for sure, no matter what, this is not going to change, this is what we're going to use. So for the course of, for the sake of this course, we're just going to use the numbers right out of the MREA book. So let's keep going and we'll go to the next slide. And we're going to talk some about expenses, because this is where it gets fun and a little bit dicey sometimes. So first of all, under staff salaries, key word here is staff salaries. This is not the owner's salary. If you go to the very back of the MREA book, where there's the example of the profit and loss under salaries, it doesn't say owner salary. We're going to put the owner salary somewhere else. Now, just as a little side note, The profit and loss, just remember, the profit and loss never goes to the IRS. They don't want a copy of it. One of the problems that we run into as coaches is that the CPA or the accountant, they use a profit and loss to write off as many expenses as they possibly can. That's their job. Where it gets a little bit sideways is that as coaches, we use the profit and loss to see how much it actually costs our client to run their business. And so there might be some things that the CPA wants on the profit and loss, but we as coaches might not want it on there because it's really not a cost of keeping the lights on. It's really not a cost of what does it cost you to actually run your business. So here's what I teach on this, is that if the CPA wants it on the profit and loss, if they don't want it what we're going to call below the line, which we'll talk about more in a minute, the CPA, they get to choose. So we're never going to, I don't ever want to cause any kind of adversarial relationship between the client and their accountant. My coach says, you're doing my profit and loss wrong. We're not CPAs. We're not going to pretend like we are. We might make some suggestions, but let's just say that the CPAs or the accountants, they trump whatever we say. So if they want it up there as one of their expenses, we're going to leave it there, but as coaches, we might back that out of our number in order to figure out how much they're really paying in one of these categories. And I'll give you an example of that as we go. But let's take a look at this. So salaries. We have the salaries. This is also if you have contract labor. It might be a runner, you know, some part-time people. That's going to go under a salary. Think of it this way. Salaries are the people that we pay to help us to run our business. Administrative assistant, transaction coordinator, a runner. You're also going to have in here the cost of hiring. If you're having to do ads for finding talent. If you're having to pay for behavioral profiles. We also should be putting in our salaries taxes that are paid by the company. As a company, and you have W-2 employees, you're going to be required to have to pay part of the taxes for that employee, and that's going to go in here. Any bonus that we pay to our employees, any health insurance, that's all going to go under salaries. So now let's move into the next slide of lead generation. Now, the very first two examples that you have here, and this is not completely inclusive. This is just to give you some ideas of what's going to fall under lead generation. You might have photography. Well, I've had a lot of clients say, well, no, photography is a cost of sale. I mean, I had to do the photos because I was selling a property. Well, no, you have to pay for photos whether you ever sell it or not. So remember, cost of sale is if I didn't have the sale, I wouldn't have had the cost. A photographer is going to expect that you're going to pay them when he delivers photos, not when you actually have a sale. Same with staging. Other things that are going to be a lead generation expense might be like Boomtown and the like, advertising, business cards, signs, Zillow, pay-per-click, open house costs. If you look in the back of the MREA book, you'll also see some more things like client meals. There's not one of the 9 categories called client meals. So in essence, we're having to find a way to, sometimes we have to shoehorn in a little bit. Every single one of our expenses really should fall into these 9 categories. Because if you look at the MREA book, there is no category that says other. Let's keep going and then we'll talk more about that. On the next slide, you'll see we have occupancy. Think occupancy of this as this way. It's the space that they're having to pay for in order to run their business. So it might be an office or two in the market center, cubicles. Another thing that they might be paying for is a storage unit. You know, a lot of our clients might be staging their own properties. And if so, they might have a storage unit. Or they might have a storage unit for all their old paperwork, but that would fall under occupancy as well. Technology. What is the technology that the client is using in order to help run their business? might be eEdge, it might be Top Producer, it might be their Mojo dialers. We're just thinking about the technology that's not just for lead generation. Now, I know a Mojo dialer would be, but it's really a piece of technology. It's not a lead generation item. So I would stick Mojo dialers under technology. And there's a host of other things that could go under technology as well, but just think, what is the technology that we're using in order to run our business? Phone. If you want to be entertained, go to the back of the MREA book and you'll see things like pagers, fax machines, and such. Watch for phone. Now, there's one client that I coach. He's a single agent, and it was with one admin. And I was looking at his profit and loss, and 1 month of a profit and loss, his cell phone bill was over $750. So the first thing I thought was, who are you calling? But then we always have to come from a place of curiosity. So when I talked to him, I said, why do we have $750 for 1 month of a cell phone? And he said, oh, well, that's my whole family's plan. I said, well, how big is your family? Well, it was me and my wife and my kids. And then I also put my brother and his wife and his kids on our cell phone plan. So it doesn't cost him $750. That to run his business, for his phone for his business, but his accountant also told him, go ahead and put it all in your profit and loss and we can write it off. So in that case, because we really want to know what is it going to cost our clients to run their business for a month, you might have to just take that cell phone bill and divide it by however many people he has on the plan and just use that amount. So watch the phone. There's interesting little things that sneak in there into the phone category. And then supplies. This is basically office supplies. If it goes on your desk or in your desk, it's probably an office supply. One of the ways to think of it is that it's kind of it's just a general rule of thumb. It doesn't always work, but general rule of thumb. If you can plug it in, it's probably equipment, and if not, it's going to be an office supply. File folders, paper, hole punch, staplers, and so on. Those are all going to be office supplies. Sometimes copies. So let's go to the next slide and we see education and dues. This is going to include MAPS coaching. This will also include their events. So they're getting ready to go to Mega Camp. It's also going to include their travel expenses in going to Mega Camp, their flight, their hotels. You might even stick their meals here. Their board dues. Remember, this is education/dues. Any continuing ed that they have to do. Any dues perhaps for re-upping their license, their real estate license. So anything that they're, any due or any education, whether it's for themselves or for a team member, has to go into under education. So on the next slide, we see equipment. So a few examples are computer, printer, office furniture. Again, if you can plug it in, oftentimes it's going to be equipment. If you have a fax machine. And then we have auto/insurance. So the automobile category gets a little fun sometimes. Now remember, unless you are one, we are not CPAs, we are not accountants, and therefore we're not going to advise our clients as if we are one. But if we see something just a little bit squirrely here, for instance, I've seen profit and losses that they're paying for gas, for car repair, and they're also reimbursing themselves for mileage. Now, my understanding of IRS rules is that you either do one or the other. So when I see something like that, I just merely say something to the effect of, you might want to go back and check with your CPA and just make sure that you're able to write off both of these. Now also, just remember, we're always going to come from a place of curiosity. So I did see mileage and gas and repairs and oil changes and stuff like that. So I just simply asked the client, are you attempting to write off mileage as well as gas and supplies? And he said, oh, no, 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 no. The mileage on here is for my admin when she has to go run errands for me. That's her mileage, and I reimburse her for that. So that's fine. That goes under auto, and that makes perfect sense. Insurance. A lot of people have business insurance. You might have E&O insurance, and all of that's going to fit into these categories. Now, in a perfect world, we would see all of these 9 categories of expenses. We'd see a profit and loss with everything then lined up under one of these 9 categories. Yet oftentimes when we get a profit and loss, we might see line items as the first one is advertising, and then Zillow, and then auto, and then salaries, and then it goes over to top producer, then it comes back to salary taxes, and so on. So as coaches, it's going to be our job to actually kind of dig down into the profit and loss and determine every single one of those, what category of the 9 that it should go into. Add them up, and then you're going to just finally, you're going to take that final number, whatever that is that we've added. We've marked everything that we think falls under auto and insurance. We add those all up, take that number, divide it by total income, and that's what gives you their percentage. That's how much they're spending in that category. And you could do this with every single one of the categories. Now, where it gets really fun is when there's something on their profit and loss that doesn't naturally fit into one of the 9 categories. So the way that I recommend that you do this is you just run it through the lens of the 9 categories. So let's take, for instance, client meals. I'm out showing a client property. We're going to stop and have lunch, and I'm going to pay for the meal. And we just think to ourselves, I don't know where to put it. So let's just start at the bottom and work our way up. Is it an automobile? We know it's not that. It's not equipment. Is it education? Is it supplies? Is it telephone? It's not a piece of technology. It's not my rent space, and it's not a staff salary. So we really only have one other place we can put it. That's going to be lead generation. That's the place where it makes most sense. It might not perfectly slide in here, but let's face it, if we're out showing the client property, we're really working with one of our leads or one of our customers to get them to buy a property. So it makes most sense to put it under lead gen. We're also building rapport with that client so that we eventually get referral business from them. And referral business comes when we're doing lead generation. So that's where we might slide that in there. But let's take a harder one. What about their bookkeeping expense? Where are we going to put that? So let's start at the bottom again. My bookkeeper is not an automobile. She's not a piece of equipment. She's not education. Supplies, not really. She's not really an office supply. She's not a telephone, not a piece of technology, certainly not rental space. I'm not doing any lead gen with my bookkeeper, and she's not on my staff. She's not my salary. So where are we going to put that? And by the way, they're typically maxed out in salaries anyway. So the last thing we want to do is throw more stuff into salaries if it doesn't really belong there. So things like that might be the never answerable question. I can just tell you from best practices, as I've looked at a lot of profit and losses in the past, is that oftentimes I see the accounting, the bank charges, and the bookkeeper, I see that under supplies. They're supplying, basically, a profit and loss to the team. So to answer where really should it go, quite frankly, I don't know. I just know that most of the MREA bookkeepers that I have worked with, probably 95% of them, all put that under supplies. All right, so let's go to the next slide called Below the Line Expenses and Income. So when we get to the bottom of the 9 categories, or we get to the bottom of all of the expenses, now we can put on the profit and loss some of the expenses that they've used business funds to pay for, but they really didn't have to pay those things in order to to keep the lights on. It's not a fixed expense of running the business. So some of the things that you might see on here, this is where you might see an owner's salary. If they just decide to W-2 themselves, this is where you see the owner's salary, the owner taxes, the owner's health insurance as expenses. Profit share, this is going to be below the line income that's going to come in. Teaching a class in a region, if they're getting paid to teach classes, that can also go into below the line income. Botox. Now I know that you're all on mute, but I can hear some of you laughing. There's actually a client that I've worked with that her CPA says, oh no, absolutely, you can write off your Botox. Well, personally, so here's how I'm thinking of it. As coaches, we want to coach our clients into having a 3 to 6 month reserve for emergency funds. So if we're gonna have them put 3 to 6 months of emergency funds aside, so that we can, if something should happen to that rainmaker and they can't do anything for 3 to 6 months, we can keep the business running. We can keep, lead generating to people. We can keep the lights on. We keep our office space. We probably don't, Botox is not going to be an absolute needed cost. So when I'm looking at her profit and loss, I just move it to below the line. Now, her CPA wants it above the line. I don't care. All I'm going to do is I'm going to take it out of the total expenses so that when I figure up the client's total expenses percentages, I'm taking out all of the things that they use their business card for that were really not a cost of running their business. Charitable contributions. That really could go below the line. You don't have to give to a 501c3, to a charitable organization, in order to run your business. I think it's great if you choose to, but you don't have to. Now keep in mind, again, that the IRS doesn't see your profit and loss. And all of these things below the line, the accountants can still write them off. They can still, when they figure their business taxes, they can still write all these off. Again, as coaches, we're just looking for what does it actually cost them to run their business. So again, if they have Botox, they might have their cleaning of their clothes, whatever, up above the line as an expense. I'm just going to take that amount, take it out of the total expenses, and then my new total of expenses, I'm going to divide that by the total income, and that's going to give me their percentage of what they're running for expenses. And then we're going to look at page 193 and see if they're in alignment with where they should be. So let's go back to page 193 again. Their cost of sales should be running 29.2%, and their total expenses should be running 29.2%. If you go over to page 157, you'll see that it's quite different when we look at, let's just look at the first column. The person doing $6 million, their cost of sales is going to be $21,000. Basically, it's only their cap and royalty because they don't have any agents on their team that they're doing splits with. Their expenses are going to be 33%. If you go over to the agent that's grossing $500,000, their cost of sale goes up when they get there because this is about when they start to bring on a listing agent. So that's going to go, their cost of sale is going to go to 20%, and their expenses are going to be at 31%. So you might want to just do the math with each one of these and just write it in your MREA book, because on page 157 it doesn't give the percentages of cost of sale. So I just have them written in. At $350,000, the far right one, under 1.2 million, that $350,000, that's 29%. $250,000 is 31%, and the $100,000 is 20%. So the reason I bring this up is let's make sure that we're coaching them to the right numbers, the right percentage, based on what kind of production they're actually doing. So look at column 1. Again, cost of sale, $21,000 divided by their total income, $180,000. That means their cost of sale should only be 11.6%. So just make sure that you're coaching them to the right number. And then if you look down at the bottom, figure 19 of page 157, or at least it's in my edition, page 157, is then that breaks down all of the categories and the percentages for those. So remember that on page 193, salaries are supposed to be 12%, but in column number 1, it's only 11%. And again, I know it doesn't sound like a whole lot, but 1% of $180,000 is $1,800. They could be off $1,800, which doesn't seem huge. When they get up to $350,000, 1% is $3,500. Now, if the client, they're off just a little bit here, just 1% here and a 0.5% here, and then, just, well, a couple percentages over here, and all of a sudden they're off $3,500 times, 4%. That's a lot of money. It could be, $14,000, $15,000. So just watch that they're not getting too far out of alignment with each one of these. All right, so let's go to the next slide, net profit. So now, back to the beginning, we had a total income of $146,657. We're going to back out now their cost of sale, which is $45,010.16. And we're just going to say that this client's expenses was $42,997. And you can see I have the percentages over there to the side. So that gives them, if we take the total income minus cost of sale minus expenses, their net profit or their owner profit at the end of the month was $58,650. In other words, that's 39.99%. 39, let's just call it 40. 40% of everything that this client brought in, he and the team, actually stayed in as owner profit. And these expenses, the $42,997, that's before all of the below the line issues. This is just the 9 categories. So as coaches, it's really important that we go through their profit and loss. We know how to read them. We start categorizing every single line item to make sure that they're within budget. They're within the, whether it's page 157 or 193. Is your client actually within budget? And then we can start making adjustments to their profit and loss, to their spending, based on where they are. It also gives you an opportunity to remind them before they go to family reunion and mega camp. If they're tapped out in lead generation, this is when you have to be having the conversations with them. You have no money to spend in a shiny object at family reunion or at mega camp. So keeping them from doing some of their spending. Leading with revenue. Playing red light, green light. Our job as coaches is to help them to keep as much money in their pocket as they possibly can. And so really watching those expenses. All right, so Allie, let's open up the phone and see if we have any questions right now. And let's start at the beginning. So let's start with any questions around income.
I do want to say, everyone, we are about to unmute each of you. So if you are in a noisy location, if you could please just re-mute yourself, we would greatly appreciate it. Thank you.
Okay, any questions at all around gross income, how we report income?
Hey, Jeannie, I got a question.
Okay.
What's the benefits of keeping the splits of the?
Okay, perfect.
Sorry.
Okay, whoever's talking about how something's perfect, could you please mute yourself again? We can't hear the question. All right, so I'm sorry. Go ahead again. What's the benefit of what?
So you have the income broken down there for the buyer agents, their buyer agent splits. Why wouldn't you just break it down in the cost of sales? Why do you have it up there in the income for each agent? Why wouldn't you have it just agent on each cost of sale? Do you understand what I'm saying?
We have to. I think so. Well, we want to show it as income for sure. We have to show it as income so that we know how much total income we brought in. Now, are you asking why we break it down into 4 individual agents?
No, I'm just asking why is that income up in the income part and not in the cost of sales broken down for each particular agent?
Okay, we broke it down. Okay, that's a really fair question. So, and I think I understand what you're asking. We broke it down in income because this particular client wanted to see what each one of his agents was bringing in on a monthly basis.
Okay.
He knows what's going out to each one of them because we already broke it down on income. So it's obviously going to break down the exact same way on cost of sale going right back out.
Okay. Okay.
Does that answer your question?
Yeah, that does answer my question.
Now, I will tell you, though, a lot of teams, they just lump it all together. They just put listing income and they put buyer income.
Mm-hmm.
I just use this as an example to show you how if you do divide it out, you also can get a more coachable moment at being able to see that. And also, you know, with this particular client, you really could be talking about, looks like client, you know, one of your buyer agents is doing really well. You got a couple more that are falling way behind. So it just, it gives it, the more data we have, the more opportunity we have to coach to that data. So that's a good question.
Okay.
Thank you.
Okay, so you put it in under income and then you back it out on the cost of sales, right?
Correct. Exactly.
Okay, I'm with you. Thank you very much.
Absolutely. Okay, any other questions on income?
Yes, Jeannie, this is Donna.
Hi, Donna.
Hey, how are you? If a rainmaker is still listing, but they have listing agents as well, would the listing agent income be separated out like the buyer agent income, and would the part that the rainmaker is keeping stay in listing sold income?
Yeah, that's a really good question. So what happens if we have an additional listing agent? How do we report that?
Right.
You know, again, it can boil down to the individual client that we're working with. If they want to break it out, listing income rainmaker, listing income other, they can do that, or they might just choose to lump it all together.
Mm-hmm.
Now, here's another little trick, because most of the clients that, I don't know about you, most of the clients that I work with, they have it lumped together, listing income, buyer income. If you want to have it broken down, you can go into their team report in our reports in MyKW, and you can pull their team report, and it will actually divide out every single one of the clients. How much GCI did they create, how much volume, and how many units did they close? So if they want to lump it all together, that's fine. If they want to kind of spread it out on their profit and loss for ease of being able to quickly look at their numbers, either way. Bottom line is all income needs to be reported under their income.
Okay, thank you.
Good question, you bet. All right, any other questions under income? Okay, let's move to cost of sale or cost of goods sold. Any questions under that category? Just remember, if it didn't have a closing, we wouldn't have had that cost.
Hey, Gene. Question for you. This is Danny Thompson. How you doing? Can you hear me?
Thanks. We can. It's a little echoey, but we can hear you.
Okay. So if you have that's kind of along the same lines of how you report that income. If you have a listing agent who's the lead agent, the rainmaker, their business is listing. They have, let's say, 3 buyers agents. This is actually real life. She doesn't really pay herself regularly, so the cost of sale looks really good on the P&L. It's like 19%. So I challenged her to, like, how much are you paying yourself? Well, you know, right now I'm putting the money in, but if her goal is to replace herself, that number's not reflecting accurately, because if you had to pay somebody for that, you would have a cost of sale. Should I advise her to either pay herself or at least estimate what she would be paying so that we can get a real read on cost of sale?
Yeah, that's a really good question. I get asked that a lot. So bottom line is, if the rainmaker is not putting what they're taking out under cost of sale, then basically what they're doing is they're not reporting it in cost of sale, and basically what they're doing is they're just taking out of their net profit anyway. So now the question that Danny is asking is, well, what if when they replace themselves, that number is going to instantly go up because now they're suddenly paying somebody to do that. If you just look at the organizational model, here's how I coach to it. I don't know that there's a right or wrong way, but we add that listing agent in level 5. So when we get to level 5, if we're looking to replace ourselves soon, by then we need to have in our cost of sale what we're paying ourselves that's going to very soon be going to somebody else, so that our profit and loss doesn't go through, just having tremors and just this shock when we actually have to move off. So we want to start to reflect what we're paying ourselves when we're getting close to replacing ourselves. And that way, because we want to make sure that we have enough net profitability left over, so that when we start paying somebody else that amount, let's just say it's $100,000, when we start paying somebody else that amount, we already know we've got money coming in as our net profit. There's too many teams that we've seen that they're only looking at, I've got a really good net profit. My net profit's great because I don't, but they're not paying themselves anything. They bring somebody else in, they start paying themselves, and all of a sudden their net profit goes down to like 5%. This business that I've grown for 15 years, now all I'm getting is 5% out of it. I should just shut the thing down. So just keep in mind, when they get up to around level 5 in the organizational model, this is when by then they should really start to reflect paying themselves something, because it's about to switch to go over to a different person.
The brokers.
The brokers.
Right.
Okay.
So you need to say, I can run that by the brokers.
Okay.
Whoever is talking about running it by the brokers, could you please mute yourself? We'd appreciate that.
I can say, hey, look, I want to be clear with you.
Yeah, you know.
Or we could just all listen to what they're going to be clear about. Okay, any other questions under cost of goods sold?
In the yard? Yeah. Yeah, he does that pretty normally. Really?
Allie, is it possible for you to mute whoever that is, please?
Yeah.
Okay, let's add, how about
I'm
expenses?
looking to find them.
Okay, thank you. How about expenses? Any questions under the 9 categories of expenses?
Oh, it's up there. We don't have.
I am going to ask, because of the amount of background noise, if you get muted out by me, I'm just testing to see if I can find who this is. If you get muted out, please type a question in the questions box to let me know that you have a question, and I'll unmute you. I'm going to be muting people in and out to see if I can find that individual.
Where's Ryan Rua?
Okay, any questions around expenses?
Hey, can you hear me okay? Hello?
Hello, okay, is somebody asking a question? Whoever just said, can you hear me okay? Are you asking a question?
Yeah, this is Chase. I'm asking a question about expenses in terms of
Great, thanks.
the CRM. Is that listed under tech or lead gen?
That's a really good question. I most often see it listed under technology, because they're using that technology kind of as their electronic Rolodex. And I know that oftentimes they also send their 36 touch campaigns out of that. So you could have an argument, well, really it could be under lead gen, and you could also argue that it could be under technology. And so when I was looking through the MREA book, more often than not, it really kind of hinted that this is really more of a technology piece than it is a lead generation piece. And also, one of the reasons that I often see it under technology is because we might use Top Producer for our CRM, but we're also in addition using maybe Boomtown and then Follow Up Boss and some of these other programs that are out there. And so it's kind of just a judgment call. You'll see lead gen lead gen and salaries is a huge amount of all of our expenses. So sometimes it might even make sense just to put it in technology so that we're not too far over budget in lead gen.
Okay, and some of those big platforms like a Boomtown, which has a CRM, and then it also has a front-facing website and marketing, some of them are split out where they have a marketing budget. So would you say take the marketing budget and that's lead gen, and then take the rest and that's tech? Would that probably be a way to do it?
That'd be a great way to do it if you can get that split out. Yeah, that would be a great way to do it, because the more real the number you have, the more you can coach to it. Yeah, if you can split it out, do it.
Perfect. Thank you.
Absolutely. So that brings up one other point that I really want to make here is remember that this is the budget model. It's not a law. It's what Gary has suggested, and he knows that some of the millionaire real estate agents that he interviewed in order to write the book, this is the collective thinking of all those agents. You might have time. You might have clients that from time to time, you're going to have to adjust their budget percentages. So for instance, I have a client that I work with, he and his team, and they're in Manhattan, and they work on really high-end properties. They have a full-time concierge. Nowhere in the organizational model do you ever see one of the circles for a concierge. So they have chosen to be over on salaries because of the high level of customer service that they offer, and they've chosen to then be low on lead gen. So they kind of borrowed from lead gen in order to pay for salaries. So we just have a budget that's lower in lead gen because we know that we're so much higher in salaries. So there might be one-off times like that. So just come from a place of curiosity. Now, 95% of your clients probably should fit right into the budget model and this type of a profit and loss, but there are going to be those one-offs. All right, other questions around expenses?
Jeannie, I have a question. This is Donna again.
Hey, Donna.
Hey, it triggered when you said concierge. How about an ISA? Is that under salaries? I've heard that it could be lead gen.
Donna. Tony DeSello said last night, you know somebody's going to ask you about ISAs. And I said, well, we'll wait and see. Okay, so here's what we're saying about ISAs, because we've got different ways that ISAs are being compensated. So those that are being compensated with a flat salary plus commission, their salary is going to go under salaries. Their commission, their 5 or 10% or 15, whatever it gets, that's going to go under cost of sale.
Okay. So the commission piece goes under cost of sale. Got it.
Correct. Good question. Tony will be proud. Good. Okay, we've got a few more minutes left. Any other questions around expenses or around below the line? So let me just give you because we got a couple more minutes. I'll just tell you some of the best practices that I've seen is that getting the profit and losses, first of all, that can be arm wrestling with your clients. And so here's the best practices that I've seen that I've put into practice in my coaching. And these aren't my ideas. These are ones that I've stolen from other great coaches. At the end of the month, I send out an email to everybody on my coaching roster, and I tell them, it's that time again. I'm looking for your profit and loss within the next 15 days. And then, so that'll go out on July 31st. On August 7th, I will send a reminder, 7 more days, and I need everybody's profit and loss, please. And when I send the reminders, I get them way more often. So that's one good practice in order to get those, because all of a sudden it's 2 or 3 months and you haven't looked at a P&L and these people are way off. Correcting something in 30 days is way easier than correcting something that we're 90 to 120 days into. Now, when I'm looking for profit and loss, I can tell you, again, this is what I've stolen these ideas from other coaches. I'm looking for 4 documents. I'm looking for the monthly, so I'll be looking for July profit and loss, the summary page, the July summary, the July detailed, which is going to show me every dime they spent and who they spent it with. I'm looking for the year to date, and then I'm also looking for the balance sheet. The year to date is what we're typically coaching to. We're always watching their year to date. And then I'm using the monthlies. If something looks kind of squirrely in their year to date, I can go back to the monthlies and kind of break it down to see where did we get off track, what are we paying for here. And then the balance sheet. Real quick, I'm going to talk about the balance sheet. You know, I talk about the balance sheet a lot. It's what I refer to it as the big, hairy, green, scary monster under the bed that nobody wants to look at because we don't understand it. And so if you want to understand a balance sheet, you can Google understanding a balance sheet, and you'll get a really good tutorial. But as coaches, here's the bottom line, and this I got from Glenn Neely. What we're really looking for on the balance sheet, remember that the balance sheet is made up of 3 sections: assets, liabilities, and equities. As coaches, what we really care about is under assets. That's going to show us how much money they have in the bank. And as coaches, we should make sure that all of our clients have at least 2 accounts: their operating account and their tax account. Are they putting money away for their quarterly taxes? And if you're looking at this every single month with your client and reminding them, you've got to be putting money away for taxes. Did you put 30% away for taxes? When are you going to move 30% over for taxes? You will help them to never have one of those oh crap moments in August or in April when taxes are due. So what we're looking for is under assets, how much cash do they actually have in the bank? So just because somebody's net profit year to date or for the month is $140,000, if they've only got $12 in their operating expense, that means that they're taking all of that money out as an owner distribution, and who knows what they're spending it on. But we have no money in the bank. And remember, as coaches, we're always coaching to have a 3 to 6 month safety net. So are they keeping money in the account? Are we watching that tax account to make sure that they're putting money in, and quarterly they should be making quarterly payments out of that? Remember, the relationship is one of partnership. So as business partners with them, we've also got to be watching all of the money with them. So get the balance sheet and just take a look. Just because they have a huge net profit, this client profited $45,000. No, that was cost of goods sold. This client was 58 net profit after all their expenses was $58,650. And I want to see, where is that money? How much of that are they taking out to pay themselves? Do they have a regular amount that they're taking out as an owner distribution regularly, or are they paying themselves? Are they putting money away for taxes? Or are they saying, sweet, look at all this extra money we have, we're going to go to Italy for a month? Don't let them get caught into thinking just because they have a huge month, they've got extra money to spend. We're always interrogating that asset amount on the balance sheet to make sure that we're building that up so that we actually have a safety net. Okay, I think we have time for one very, very quick question. Does anybody have one more quick question? Okay, then I think we're good to go. So thank you so much, everybody, for your time and being on with me on this course tonight. If you got any questions about the profit and loss, you can always email me. I'm more than happy to help in any way I can. So thanks so much, and have a great night.
You too.
Thank you very much. Great job.
Thank you.
Thank you.
Thank you.